We're diving into an investment report today, one titled Super Microcomputer. The AI comeback story of 2026 starts now. It's all about charting SMCI's path from, a pretty rough 2024 governance crisis to a huge AI future, targeting $36 billion in revenue.
And that comeback narrative is set up really well, but for a thesis this big to really hold water, we have to get right into how the risks are actually quantified. So my first point is this. The analysis needs to integrate the trust discount into the financial evaluation more quantitatively to really ground that PE discussion.
Okay, yeah. The shadow of 2024 is definitely there. The report calls it the ghost of 2024, the whole thing with Ernst & Young resigning, the filing delays.
Right.
And it points out that this is why there's still a trust discount. You see it in the PE ratio, right? It's sitting at about 26.5x, which is way lower than its peak multiples.
It sees it, yes, but here's the weakness. The report treats that discount as this qualitative risk factor, something that could cause a drop.
A background threat.
Exactly. It stops short of using that discount as a measurable variable in the valuation right now. So the whole bull case, the whole undervalued argument, it ends up relying a bit too much on a subjective feeling about management, not a hard number.
That's a really sharp distinction. So if the thesis is undervaluation, you're saying we have to be able to mathematically point to where that value is being lost. But how do you actually calculate the cost of trust?
Well, the suggestion is to move beyond just saying the discount exists. You have to quantify the opportunity if that gap closes. And that means benchmarking.
Okay.
Directly benchmark that 26.5x PE against a real peer or maybe a basket of peers like Dell or HPE. That's how you establish the exact numerical value of that governance shadow.
But hold on. Isn't that a bit of a challenge? SMCI is a pure play, high-growth AI server company. Dell and HPE are these massive, diversified legacy businesses. Are we really comparing apples to apples there?
And that is precisely the analytical work the report needs to do. That's what makes it a higher-level analysis. The comparison isn't about saying the businesses are identical.
Okay.
It's about isolating the part of the multiple that isn't explained by growth, and then you can assign that difference to the governance risk. The report could say, for instance, that after adjusting for SMCI's better growth rate, its PE should be 35x.
Ah, I see.
And that difference between 35x and the current 26.5x, that is the measurable cost of the ghost.
Right. That forces a really useful constraint on the argument. It's no longer just the stock is cheap because of old mistakes.
Exactly. Now it's the stock is quantitatively X% cheap because past mistakes have imposed a Y multiple penalty.
So a concrete example would be to reframe the bull case.
Yes, don't just say 26x PE is cheap. Get specific. The analysis could state something like, if SMCI traded at a growth-adjusted multiple of 32x, the stock price implies 21% upside. That suggests 21% is the current measurable penalty from the 2024 accounting crisis.
That's very powerful. Or I suppose you could give a target for where the PE would land if they, just fix the filings. Stabilize margins above 10%. That gives the reader a clear waypoint. It defines the prize.
Absolutely. It turns a subjective warning into a concrete opportunity. That strengthens the whole thesis.
That's a fantastic point. And it actually leads us perfectly into the second major issue here, which is the whole competitive dynamic and the struggle over profitability.
I agree. This is where the tech story and the market reality really collide.
So the report highlights this core tension. On one side, SMCI has this major technical advantage in direct liquid cooling DLC. It supposedly doubles compute power, lowers costs. They're the liquidity king.
That's the story.
But on the other side, gross margins have just plummeted to 9.3%. They were 13.3%. And that's because of this fierce price war with Dell and HPE, who are selling themselves as the safe pair of hands.
And the crucial distinction between that alleged tech moat, the DLC, and the reality of margin compression needs a much more explicit synthesis to clarify if this comeback is sustainable.
Right.
The weakness is that the report just presents them as two separate facts. Here's the cool tech, and over here there's a margin war. It never really digs into why the so-called liquidity king isn't protecting its own profitability.
That is the paradox, isn't it? If your tech is that good, that much of a game changer for customers, why are you in a price war that crushes your margins below 10%? The moat should be reflected in the margin.
And that is the analytical pivot the writer needs to make. The suggestion is to really define whether this margin pressure is a temporary strategic cost.
Like a land grab?
Exactly. Are they taking profitless prosperity to capture that huge 13 billion Blackwell backlog? Or is this margin compression a sign of something much more dangerous?
That AI servers are just becoming commoditized boxes, and the DLC advantage isn't really that exclusive or can be easily copied.
And if that's true, the whole liquidity king thesis just advantages. So the report needs to move beyond just stating that liquid cooling is a genuine moat. It has to analyze the counter-argument, force a judgment.
So if we look at it as a strategic sacrifice, what does that mean for the timeline? Is this margin pressure over in 2 quarters, or is the company planning to run lean until they hit that $36 billion target in 2026? That's a huge difference for an investor.
Yes, and the report has to provide a framework for judging that strategy. A really actionable way to do this is to explore whether they're taking lower margins now to lock hyperscale customers into their ecosystem for the next generation of chips.
That reframes the whole margin discussion. It's not just a weakness anymore. It's a calculated cost of capturing market share.
It is. So for a concrete example, the conclusion of this section needs to be explicit about the trade-off. It should say something like, SMCI is paying X in margin today to secure Y market share and lock in key customers for the next 5 years.
That is so much clearer.
Or even better, the current 9.3% margin implies the market values the DLC moat at Z basis points, a cost management believes is justified by the scale of the Blackwell backlog. This moves it from a description of tech to a sharp judgment on strategy.
That's excellent. Okay, so we've covered strengthening the financial case and the competitive analysis. Let's talk about structure and flow. I mean, the pacing of an argument is everything, and I do think the report tries to make a good pivot in the executive summary.
It does.
It moves from the negative audit survival story to the big, positive $36 billion server build question. The arc is there.
The arc is correct, but the pacing needs a serious shot of adrenaline right at the start. The narrative punch is diluted because the most explosive, concrete data is held back.
You're talking about the backlog number.
I am. The specific proof that makes the pivot work, that huge $13 billion Blackwell Ultra server backlog, is only introduced in Section 2, the catalyst.
Ah, okay. I see.
By saving that number, the executive summary lacks the strongest, most immediate proof that the comeback is already happening. It says management has immense confidence, but that's just a projection. It doesn't immediately back it up with the funded backlog that justifies that confidence. The weakness is a delayed gratification of the best data point.
So the writer is leading with management signaling confidence, when they should be leading with the fact that management is already delivering on a funded pipeline. It makes the whole thing feel less certain.
The suggestion is critical. Get that $13 billion Blackwell order number right into the key signal of the executive summary immediately. Use that concrete figure as the foundation, then pivot to the raise guidance of 36B+.
That one structural change totally alters how a reader engages with it. It erases any doubt about their ability to execute and gives the whole comeback story some real weight from the very first paragraph.
It anchors the argument in today's reality, not tomorrow's hope. For a concrete example, you have to restructure that opening. Right now, it starts by mentioning the Q1 revenue miss.
You flip the order. Emphasize the strength first.
Yes. Make the punchline the opening line. The revised summary should lead with something like, despite missing Q1 revenue estimates, management's immense confidence is immediately supported by a massive $13 billion backlog specifically for Blackwell Ultra servers, leading the company to raise its full-year FY 2026 guidance to 36B+.
That's such a subtle but really powerful change. For this audience, seeing a secured $13 billion pipeline just immediately shifts their frame of reference. SMCI is no longer a speculative turnaround. It's a growth story that's already happening.
Exactly. When you have a massive funded order backlog, a real asset, that has to be your lead. Delaying it just weakens the entire report.
Okay, we've covered 3 big, really actionable areas for improvement here. To summarize for the listener, we focused on maximizing the valuation argument, synthesizing the competitive analysis, and elevating the narrative pacing.
And the actionable steps are pretty clear. First, you have to quantify that trust discount in the 26.5x PE ratio. Stop treating it as just qualitative and calculate the implied upside from closing the governance gap with peers.
Second, explicitly analyze that trade-off between the DLC tech moat and the 9.3% margin compression. You need to take a stand. Is this a strategic cost to get to $36 billion? or is it a long-term commoditization problem?
And third, fix the pacing. Immediately front-load that $13 billion Blackwell order backlog into the executive summary. Anchor your thesis in secured revenue, not just projections.
If you make those 3 changes, this AI comeback story of 2026 shifts from a speculative argument to a really robust and quantitatively supported investment thesis.
This is excellent material